Annex. As always, got a question for us. Head to our website, annexwealth.com. Look for the Ask tab. If we can help, go ahead and click that Get Started button. Sarah Kyle's in the studio, Wealth Manager at Annex Wealth Management. Hello.
Hello, Danny.
Matt Morzy, Investment Team Manager and a CFP at Annex Wealth Management. Welcome back.
Hey, Danny.
A couple of planning questions, and we'll get to a tax question. First one is anonymous. Until inflation eases, I need to contribute less to my savings and investing. I have both an HSA and a 401k. I believe I should scale back on the HSA before the 401k. What are your thoughts?
Well, there are advantages and disadvantages and strings attached to both. So like, for example, for the 401k, you could always take a loan out from that someday if you needed it, but not your HSA. But, I would just suggest if your HSA isn't invested and it's sitting in cash, I would cut back on that first and keep putting into your 401k.
Kind of comes down to what your long-term goals are, and then again, what can you access? So at HSA, I would almost look at it as like a forced savings account as well too, because if you're cutting back on expenses, one potential pitfall is going to be a medical expense. And if you're contributing to your HSA, you can pull that out tax-free, penalty-free to pay for those medical expenses as they come due. And also, if you think it from a retirement standpoint as well, once you hit 65, you can pull money out of an HSA to cover everyday expenses and not have the penalty. You just pay the tax like you would out of a traditional IRA. One thing to consider, though, too, when you're making that decision is if a lot of 401ks or retirement plans have a match from your company, you want to make sure you're at least getting that before you contribute anywhere else, too. That's free money, and who doesn't want that free money?
Here's one from Tyler. My wife and I had a child in December. I was convinced to open a 529 plan after the baby was born, but I'm starting to have second thoughts. It's a lifetime away before college comes into the equation. What if they don't go to college right away or even at all? Does it make sense to open a high-yield savings account and store the cash, gifts from family, till the baby gets a little older, then put it in a 529 plan down the line?
Well, Tyler, you think 18 years is a lifetime away, but boy, it sure goes fast. One day you're going to wake up, they're going to be driving, and they're going to be going to college in 2 years. So it's good that you're thinking about this now because it certainly goes fast. I wouldn't have second thoughts about contributing to a 529 plan. It's still a great saving vehicle. And under the Secure Act 2.0, effective in 2024, 529 plans can now be transferred into a Roth IRA in the beneficiary's name. But there are a lot of rules that come along with this, like the 529 has to be open for 15 years. The last 5 years of contributions cannot be transferred. And the beneficiary must have some sort of compensation. One other thing is the lifetime transfer amount is $35,000. But you can always consider a custodial brokerage account for an UGMA, for example. It's called the Uniform Gifts to Minors Act. That brokerage account is in your child's name, and it's also under their Social Security number. So the earnings are taxed at the child's tax rate rather than yours. And there's no limit on how they can spend that money. However, one drawback is when your child turns age of majority, that account transfers into their name, and then the child owns those assets. But the UGMA accounts can also affect how financial aid, because they have to list that asset on the application for financial aid.
It's Ask Annex, and another great example of the team concept that we operate with here, because when we get a tax question, we just head to Tania's office. Tania Sinha joins us. She's manager of tax planning and a CPA. Welcome.
Thank you, Danny.
Interesting question. I just got my W-2 and realized I did not withhold enough in taxes. What can I do? I'm afraid I'll be paying penalties and interest now. Okay. Well, I guess it depends on, did they have no taxes withheld, or did they just do their W-4 incorrectly? So we're not quite sure of that. If there's no taxes paid at all, that's a problem, isn't it?
That's a big problem. We all get a W-2s. For example, when I get a W-2 in my hand, I'm comparing my amounts from box 1, which says federal income, and then I'm comparing with taxes withheld, and I am freaking out too. Trust me, honestly. I'm like, how much did I pay? I'm starting calculating numbers in my head. So it is scary to get a W-2 in your hand and you're wondering, will you get a refund this year?
Okay, let's just say they really blew it and there's no taxes withheld. Do they need to pay taxes now ahead of filing their taxes?
Yes.
Yes.
I would suggest yes. The due date for estimated payments to be made is gone. The due date was January 18th, and people must be thinking, okay, I did not make any payments. I can just make it when I file my taxes.
Right, that's what I would think, yeah.
Right.
No,
because IRS charges penalty based on every month. The IRS charges penalty of 0.5% of taxes owed each month after the due date. So by paying now, you're going to avoid penalty for the month of March and for the month of April.
How do they figure out how much they owe?
Easiest way, use the safe harbor rule. What that is, open your last year tax return. If your total taxes owed was $10,000, and if you see on your W-2 that you only withheld $2,000, that means you need to make a payment of $8,000 right now.
Wow. Okay.
No, I get it. We get this question a lot when some people have a W-2 and then they have a side hustle or they have investments. You know, they get a 1099. They're like, I don't know how much my investments are going to make this year. I don't know how much taxes to pay. Again, do the safe harbor rule. Pay 100% of what you paid last year. Or if your AGI is above $150,000, then you need to pay 110% of your taxes from last year.
Well, this is no fun at all. And that's, of course, it's the IRS. All right. So does this get back to the W-4? Because I find that the most confounding thing to fill out.
It is. It can be very confusing. For example, we have some clients who have 2 kids. I tell them, do not even put exemption for your kids. Just put exemption 0, always 0. And then if you think you are still withholding less, there is a section that says extra withholding. You can put a flat fee in there. Depending upon your budget, how much are you willing to take less in your paycheck every month?
Tania Sinha, manager of tax planning and a CPA at Annex Wealth Management. Thank you.
Thank you, Danny.
Sarah Kyle, wealth manager at Annex Wealth Management. Thank you.
You're welcome, Danny.
Matt Morzy, investment team manager and a CFP at Annex Wealth Management. Thank you.
Thank you.